I'm Peter Ganong. I founded the Financial Resilience Lab, which is right upstairs at the Harris School, together with Pascal Noel, who's another UChicago professor. We study financial challenges which households face and help them to be resilient in a changing and volatile economy. Today, I'm going to tell you about our work on preventing foreclosures. I want to introduce you to someone named Benjamin Coleman. Benjamin lives in Miami. He graduated college. He bought a condo in Miami Beach in 2006 for $215,000. He bought it when house prices were on the up and up. A few years later, the bubble popped, and by 2010, other units in his building were selling for $90,000. What that meant is he lost his $40,000 down payment, and on top of that, he was making a mortgage payment which was substantially larger than he could have rented the same unit for much cheaper. At that time, no one knew if housing prices would recover at all, and so he felt that he was paying way too much for his unit. In his words, he said, "There is no financial sense in staying." Even though he had a job, he was perfectly able to make his payments. It just didn't make sense to do so when there was an equally good apartment available for much cheaper. To prevent someone like Benjamin from defaulting on his mortgage, he would have needed a principal reduction that reduced the amount of his loan outstanding. So Benjamin captures one idea about why people default on their mortgages, and I want to introduce you to one more person. Her name is Christine Selman. Christine lives in Woodbury, Minnesota, and her husband worked as a construction worker, pouring asphalt for driveways for new houses during the bubble. The bubble popped. There was no more work to be done pouring asphalt. He lost his job and started receiving unemployment insurance. And what that meant is that there was a dramatic reduction in his family income. And based on the reporting, both Rick and Christine didn't talk at all about the value of their home when they were interviewed. The main thing they focused on was their ability to pay. With Rick unemployed and only receiving unemployment insurance, it became impossible to make the payments. So let me tell you what Christine said. "You have to work so hard to keep what you have, and because of circumstances beyond our control now, there's nothing that we can do about it." What Christine and her family needed at this point in time was a reduction in their mortgage payments today. And during the Great Recession, there were 5 million people like Christine and Benjamin who had fallen behind on their mortgage payments. At the time, there were a variety of policy proposals to help struggling borrowers. For example, Senator Durbin, who just spoke to us, put forward a proposal to modify mortgages through the bankruptcy process. But more than anyone else in the US, the challenges facing people like Benjamin and Christine fell to Tim Geithner. In January 2009, Senator Durbin and 59 other senators voted to confirm him as US Treasury Secretary. So what did he do? Like any good Harris grad would do, he went to the data. Just to be clear, Tim Geithner is not a Harris alum. I'm saying a Harris alum would do that. And what you can see is that the mortgage delinquency rate at this point in time was skyrocketing. Nationally, house prices had fallen, not just in Miami Beach, but everywhere. And what that meant is that there were lots of people like Benjamin for whom it didn't make financial sense to make their mortgage payments anymore. At the same time, the unemployment rate soared during this time period. You can see it shooting up here, right alongside delinquencies. And during the Great Recession, the long-term unemployment rate, which is a particular measure of severe need, reached its highest ever recorded level since we've been measuring this statistic since World War II. And what that meant was that it was really difficult for Geithner and for the Treasury Department to figure out why were all these people defaulting on their mortgages? How important were housing prices and the financial sense argument versus how important was the unemployment rate and the ability to pay argument? And Geithner himself actually crystallizes this debate really nicely in his memoir, Stress Test. So what he remembers when remembering the policy debate at this time is he says, our biggest debate was whether to try to reduce overall mortgage loans or just monthly payments. So this question, Tim Geithner's question, is what we've been working in my lab to answer for the last 2 years here at the Harris School. And I'm going to tell you for the rest of this flash talk about how we've been trying to answer Geithner's question. So the Treasury Department set up a program which is called the Home Affordable Modification Program. And over the life of the program, it's now ended, they modified 1.7 million mortgages. And for the typical borrower in this program, they both offered an immediate lower payments, and also they lowered the overall debt burden on the mortgage. And the fact that this program used a mix of both of those two reflected Geithner's uncertainty and the policy and expert community uncertainty more broadly about what was going to work. Now, one piece of good news that arose from this uncertainty is that different borrowers in the program received different mixes. So some got more payment reduction and some got more principal reduction. And the other piece of good news from a research perspective is that the Treasury decided to release a public data file with detailed records on all of 1.7 million of those borrowers. And so in our lab, we got to work on this public data file together with other closely related data sources to analyze what's the most effective way to prevent foreclosures. I'm going to start by showing you an analysis that compares two groups. The control group shows you a typical borrower in this government program. She receives a reduction in payments immediately on joining the program of around $8,000 per year. The reduction is smaller in years 5 through 25. And then finally, they actually extend the life of the mortgage as part of this modification program so that on average, her payments rise a little bit after year 25. So this is the control group. Now I'm going to tell you about the treatment group. So we used a regression discontinuity design to compare the treatment group and the control group. And how many Harris students do we have and alums in the audience here? So all of you, I think, should remember regression discontinuity from Stat 2. But I'm not going to recap it in case you forgot, and I'm not going to test you on it. I'm just going to show you the results from our study. So in the treatment group, they get the same payment reduction for years 1 through 5, but they also get a write-down on the debt of the mortgage that averages about $70,000. And what that means is that for people like a Benjamin, they owe much less debt on the home, and it might make financial sense for Benjamin to stay in the home if he got $70,000 of principal reduction. Now, this wasn't cheap. The government spent about $5 billion subsidizing the dark blue group relative to the light blue group. And so let me show you the results from our analysis. So this shows you the control group that got no principal reduction compared to the treatment group that did get principal reduction. And I see some of you squinting. This is a 0. We found no effect. So unfortunately, principal reduction was both quite costly and in addition did nothing to affect mortgage default. And so by this point, we were kind of disappointed because we were trying to do a study about how to prevent foreclosures. I told you that was the title of the talk. And so we did a second study to study a different policy of a different subgroup of borrowers inside this same big government program. In the control group, you see borrowers who get a small reduction in their current payments and a small bump up in payments in years 25 and later. In contrast, in the treatment group, where we again used a regression discontinuity to compare the treatment group and the control group, there was a much larger payment reduction, about 4 times larger than the control group. Now, there's something particularly interesting and special about this treatment group, which I want to point out, which is that the payment reduction was structured in a way that the immediate reduction, you can see it down here, was offset such that by extending the duration of the loan to last for additional years. And what that means is that the borrowers in the light blue group and the borrowers in the dark blue group end up paying exactly the same amount over the life of the loan. The key difference is that in the dark blue line, even though they pay the same total amount, they pay less now and more later. And this is exactly what Christine was asking for in the context of her interview. She needed some help making payments now when her family struggled with short-term job loss. In the long term, she expected that her family would be back on their feet, and they viewed the total debt burden on the house as reasonable. So let me show you what we found from studying this treatment. So here we had a little bit more good news. The control group had a default rate of around 32 percentage points, and the treatment group had a default rate that was about 6 percentage points lower and highly statistically significant. So this policy, the dark blue group, reduced default quite substantially at no cost to taxpayers. I can summarize all of our empirical results for you in a single slide, so I'll do that right now. We did a study of principal reduction, that's on the left panel here, and we found that principal reduction had no effect on default. And we did a second study of payment reduction, which we found generated substantial reductions in the default rate. And what this means is that this study gives us an answer to the Geithner question. Our biggest debate was to reduce overall mortgage loans or monthly payments. The answer that we now have years later with good data and the benefit of time and careful study is that the solution was to emphasize more reducing monthly payments. And in human terms, what that means is that there were many more Christines who were having trouble making their payments today than there were Benjamins who were defaulting because it didn't make financial sense to stay in their home. So what does this all mean for policy? You might say, well, it's obvious, Peter. The principle is you should do more payment reduction, do less principal reduction, we're done. And you're right about the direction, but what really surprised us in the analysis was just how dramatic the differences could be from better designing this policy. So one scenario we considered is what if we gave borrowers exactly the same payment reduction for the immediate 5 years, but we structured it in a way that was more fiscally responsible. If we had structured it in that way, it would have been possible to save taxpayers $108 billion. So that's $108 billion during the Great Recession that could have gone to stimulus, that could have gone to community colleges, that could have gone to clean energy, that went into this program but was not spent in the way that was potentially most effective. We also considered a second scenario, which is let's forget about the rest of the world and just take this money and plow it back into housing policy. These funds from this redesign are sufficient to reduce mortgage payments by 33%, which would then be enough to prevent 240,000 mortgage defaults. I think this is a good example of what Senator Durbin talked about before when he said, occasionally we get it right, but sometimes it takes a long time. That we really didn't get the policy design right during the last Great Recession, but hopefully we have enough information and evidence now that when the next recession comes along, as it inevitably will, that we'll be able to do a better job of getting the policy right next time. So this is an example of the type of work that we do in the Financial Resilience Lab. We're continuing to work on understanding why people default on their mortgages, and also starting a new line of research on racial disparities in household incomes. In this study, we asked what was the best way to prevent foreclosures. And we found that the way to do so was to prioritize immediate payment reduction, and that doing this could have enabled taxpayers and other owners of the loans to save $108 billion, or alternatively, we could have prevented 250,000 mortgage defaults at no additional cost to taxpayers. In human terms, what this means is that we could have prevented 250,000 people like Christine from defaulting on her mortgage through better policy design. So, as you can tell, I'm pretty passionate about housing policy and about this line of research, and we only had 15 minutes together. So if you're interested in learning more about our research on preventing foreclosures or other work that we're doing in our lab, I've put up my email address here, and I look forward to hearing from you. Thank you.